Markets are expecting the Fed to come off the sidelines in September and deliver a rate cut. The question for many investors is, how big of a cut might we get? Joining us now to discuss, Scott Colbourne, Managing Director and Head of Active Fixed Income and TD Asset Management. Scott, always great to have you on the program.
Thanks, Greg. It's a pleasure to be back.
All right, so I love the beauty of the central banks when we think about like the things they have to weigh and the deliberations they have to make. They have the same information that we have. We know what inflation looks like, the labor market, the economy. So as you look through those numbers, what are they telling you?
Yeah, September 18th is the Fed's meeting, and the markets are expecting, and they've been encouraged by the Fed to think that they will cut rates then. The question that we've been debating is whether it's 25 or 50. When you look what's priced into the market right now, we have basically a full % cut by the end of the year, and we have 3 meetings. So the market is saying one of those meetings has to be 50 at the moment. And so the question is, does the data support 50 basis points at one of these meetings? Do they kick it off? There's certainly a range of expectations on the dealer community and in the market. On balance right now, what you see is an economy that has been slowing. It's a little bit below trend growth. The now forecasts for U.S. growth around 2%. Inflation has been trending lower. We had a good CPI print. Headline just below 3%, core just above 3%. The trend is in play. Central bank speak has been encouraging us to think that the trend is in play in inflation. I would suggest that it's hard for me, absent this volatility that we saw briefly in the markets this month, that we need a 50 basis point cut. So I think on balance, the fundamentals say we are going and moving towards a cut, not an easing cycle, a cut, because it's more risk management, and valuation may be just pushed a little too far here, right? Right now we've got maybe 1.25 cuts priced into September in the U.S. market, and probably that has to get brought back between now and September 18th. So there may be a bit of congestion, choppiness in the Treasury markets, especially in the front end.
Interesting this week when we think about all the information we were looking at, the labor market. Part of the story about why it's taken so long, I guess, for the Fed to get to the stage has been the resilience of the U.S. economy, the exceptional strength of the U.S. economy. Then we got the labor market revision. I mean, it's backward looking. We're talking about 12 months through March 2024, but it was a big number, like 818, I think, around that thing, overcounted positions. The markets, it seemed to me, didn't know what to make of it. It's like, should we be worried, or is this just like, so far behind us it doesn't matter?
Yeah, I think on balance, when you look where, let's just go, I'm going way back, but, in the beginning of, say, May, we've had about a 90 basis point rally in U.S. 10 years, right? And that's sort of like an icing at the cake here in August, that we've seen revisions going back to spring of last year that reduced, job growth, the non-farm payrolls from over 200,000 to about 170, 175,000. So it's definitely saying, good growth in the jobs market, but maybe not as strong as we had. And there's been a confluence of data, basically nudging us towards this Goldilocks environment, softer growth, improving inflation, and the Fed speak telling us that we're moving towards that risk management cut, and we'll see as we go along. So, we get the number yesterday, and in fact, at the end of the day, rates were higher, right? And I think on balance, the market, was encouraged to be more dovish and expect more. And the volatility this month, the sell-off that we got in the equity market.
Our holiday Monday.
Yeah, of course. And that spike in volatility has left market positioning perhaps a little long in the Treasury market. I don't think it interrupts the big picture in the story. And the story is that the Fed is embarking on a rate cutting process, and we'll see as the data continues to evolve. Does that job number, the trend? We had, 115 or so, the last number. Does it continue to deteriorate? We had jobless claims numbers this morning that were okay. So between now and September 18th, we get 3 jobless claims numbers. That's a high frequency indicator on a weekly basis to tell us how the jobs market's doing. We get a CPI and a non-farm payroll. So I think it all adds up. I think we really need real messiness in that data, very weak data, to get us to 50. That's how we're thinking about it. But we do think that we'll continue on the trend towards, a cutting cycle. And so it's not whether, They will. It's just how much, and then ultimately, where do we move over the course of the cycle?
Of course, with the market at some point, some participants pushing for the 50 that you don't see a justification for, some pundits talking in that direction. They're going to be looking to Jackson Hole tomorrow. They're going to be looking to Jerome Powell and say, is he going to give us any hints? I mean, he's a central banker.
Yep.
You wear your cards pretty close to your chest. At the same time, what kind of words are you listening for?
Yeah, I think we've basically opened the door. It's this sort of notion of risk management. The disinflation trend continues to be in place and is encouraging. We'll look at the totality of the data. So we had a few Fed speakers today that sort of, on balance said we continue to look at the data. And it's not horrible, but it's definitely moving in the trend. And, at the last Fed meeting, the Fed did open the door for September. So I think it's that continued risk management.
I want to ask you about that because off the top you said, don't think of the cut in September so much as easing as risk management. Is that the concerns about the strength of the labor market, the economy overall?
What I see is the Fed worried that they are too tight, right? And so if the trend accelerates here on the jobs growth, and I think the market and the Fed have sort of pivoted away from inflation concern to more economic or the dual mandate, the labor market side of things. So do we see an acceleration in the slowdown in the jobs market? And if the Fed thinks right now that they are already in restrictive territory, they don't want to wait and be reactive too much. And so they're viewing this as a preemptive risk management cut. They see the trend. They see both trend on inflation and jobs. So let's start with a cut. You can go cut or easing cycle. And an easing cycle to me is more like we're concerned about a recession. And I don't believe that the Fed nor the markets on balance believe that that's the primary focus right now.
We put this all together. What does it mean for the bond market? Fixed income investors have been waiting some time for this.
We've rallied a lot since the spring. But yields, U.S. investment-grade bonds are still close to 5%. That's not bad historically speaking. A little, closer to maybe 4.25% here in Canada. Not bad given where we've been here. So, you can decide whether you want more duration, go out the yield curve, or you can get very attractive, short-term corporate bonds and still lock in some good yields. So while we've had this big rally in advance of the cutting cycle, we are still encouraged, and I still think that money will continue to flow on balance into fixed income.